Hi, I'm Joe Patton with OhioMeansJobs.
And I'm Phil Buell with Superior Credit Union.
At OhioMeansJobs, we help people find employment, and with that comes learning how to manage a paycheck that comes with it, so we reached out to the experts at Superior Credit Union to help us with that.
We know our members may work as much as 2,000 hours a year, but don't get to spend much time planning for their finances. One of the goals at Superior is to help improve our members' financial lives. That's why we partnered with OhioMeansJobs.
We prepared the following videos for you on budgeting, checking and savings accounts, and building and repairing credit. We hope you enjoy these videos and learn something valuable from them.
Hi everyone, I know budgeting can be a drag. In fact, half of us don't take the time to make a budget, but being in debt is even more of a bummer. So it's really important to figure out how much money you have coming in each month and how you're spending that hard-earned money and where you might save. So with me today from Allen County, OhioMeansJobs, is Josh Parker. And Josh is going to talk a little bit about budget basics and how we can all stop living paycheck to paycheck. Hi, Josh.
Hi, Brenda. Yes, I am the Assistant Director here at Allen County Department of Job and Family Services and OMJ, Allen County. I handle all of our fiscal operations and grant management for our agency. I went to school at Ohio State and got my accounting degree there and have served in fiscal roles since 2007. I am currently my church treasurer as well as the treasurer of our charge group, which contains 2 different churches. I honestly feel like I was kind of born to manage people's money, businesses' money, my church's money, our agency's money. However, I haven't always been great in my own personal finances. So there was a time where I was sloppy and undisciplined. And it wasn't until my wife and I went into a financial journey with our church in 2016 that completely changed our financial trajectory. When I started this role here, Joe had brought up the conversation of the importance of financial literacy in our community and how we can plug that in with our agency and our mission and try to get it out to all the folks in the Lima area.
Great.
Yeah, so we came up with a plan to reach out to like Dave Ramsey's financial smart dollar team and brought that into our agency, and we began using it here to get our employees on the same page first, and then to start giving advice to our clients that walk through the door.
So you're really a great person to be addressing budget basics, and which is great because I'm not the best at making out a monthly budget. And it's funny because when I have taken the time to do that, I really look at those expenses and I see a lot of areas where maybe I could have saved some money. So we're going to be talking about things like that. But first, let's talk about a budget. What is it? And it really is a roadmap of sorts for success, isn't it?
Absolutely. So, a budget in its most simple form is a plan. It's a spending plan that takes in all of your income, the money that's coming in, and your expenses, everything you spend. It's looking at them on a piece of paper and being intentional with every dollar that you have in. First, I would like to add that, from a budgeting standpoint, humans are a medium for exchange. We have money that's coming in, and then we use that for services and goods that are broken down by 2 basic elements, wants and needs.
So let's talk about wants and needs and the difference between the 2.
Absolutely. So needs are a necessity. Like the big 3, I would say, are shelter, clothing, and food. A want is a luxury item in a sense. It can be within the necessity category.
Like that designer purse is a
that
want,
designer
it's not
purse.
Necessarily a need.
Exactly. Yes, a need would be to have, some sort of clothing, but once you get into the luxury designer things, that's not an actual need. A shelter could be, is a need, but a want would be a house that's 5,000 square foot with 6 bedrooms, 6 bath. Not a necessity. So food, you can look at, you do have to eat. However, steak or filet mignon every single night isn't a way to live your life in the most cost-friendly manner.
And I think people can relate to that because I think we all find ourselves indulging a little bit maybe on the want side versus the need side. So, okay, let's dive a little bit deeper and let's talk about a budget and how that works, what it might look like.
So a budget, again, is just that spending plan that we look at, comparing all of the money that's coming into your world and everything that you're spending on those wants and those needs. Our budget that we have here is a condensed but detailed budget that if you walked into our agency, one of our career consultants would go through with you to try to look at all of those income and expenditures.
So let's take a look at that budget. Let's talk about income and expenditures, or even more simply is the money that you have coming in versus the money that you have going out of your household.
Perfect. Yes, absolutely. So let's start on the left-hand side. That's the income side of our budget. So we have listed out on the left-hand side the most common income-related categories and included multiple lines for employment for multiple jobs for one person or within a family. For us, we total all the money on the applicable categories on a monthly basis. An example, if my job paid weekly and on Fridays for the month there are 4 Friday pay periods, then I'd bring home $500 each week. You would record $2,000 in the first employment line, and then you could input any additional income and resource items the rest of the way down. Next, we would look on the expenses side. That's the right side of the spreadsheet. The easiest way to complete your first budget is by pulling bills from the previous month. This will give you a starting point for expenses. As you get more comfortable with your budget, you can begin to project utilities based on seasons such as summer's AC bills or winter gas bills or any other anticipated ups and downs. Each year there's different structured things. You have birthday every year, you have Christmas every year, maybe there's a big event like a wedding, but you have to take those into consideration as you're working on your budget. If you don't have a bill, you can estimate line items, and it's important to track those expenses going forward. In order to get control of your finances, you have to put in the effort of tracking your expenditures. You can't live within your means if you don't know how much money is coming in or how much money is going out.
Josh, what are the most important points that you want people to walk away knowing today when it comes to budgeting?
That's a great question. I think the 2 most important points would be that the only way to improve your financial situation is by increasing your income or reducing your expenditures. Outside of that, there's no other way. I mean, that's just the most simple as it gets. You have to increase what's coming in or decrease what's going out.
Sure, that makes sense. And so when we talked about earlier those needs versus wants, where does that go into the budget?
Those go on the right-hand side of the where all the expenditures are. The expense side of the budget contains both needs and wants. A point I would make with those is you enter the expense items, it's important to look at them and question if there's anything you can eliminate or reduce. Cutting cable has been a popular trend in the past couple of years. Can you look at your cell phone plan and reduce it? If your car payment is more than your rent, then you should be looking at downsizing to decrease the financial burden of those payments. After all income and expenses have been entered, you'll be able to see your monthly financial position from your budget by taking your income and subtracting your expenses. The goal here is to have a zero-based budget. That means your total income matches total expenses. Every dollar is accounted for and has a place. Using this budget example we have on the screen, we end up having $55 remaining for the month. If you're just getting started and don't have a savings, we would suggest using the excess to work on building up an emergency fund or that rainy day fund. Our friends at Superior Credit Union will talk more about that shortly. We suggest getting at least $500 in a savings account as quickly as possible to help cover emergency expenditures that pop up and aren't accounted for in your budget. This set aside is not a new purse fund, but instead a cushion to keep you from starting a negative financial chain reaction.
Yes, Josh, saving money is so important, but it's not always easy to do. According to a GoBankingRates.com survey, about 69% of Americans have less than $1,000 in their savings account. And about half of the respondents said they have nothing in savings. I found this pretty surprising too, that last year there was a survey done, and 3 out of 4 Americans are living paycheck to paycheck. That's pretty alarming. So if an unexpected crisis were to pop up, you'd have nothing to fall back on for you and your family. So saving money is hard, and especially when we are in tough economic times. So what are some good ways that we could save money?
Great question. I think one of the things you could do is always try to pay yourself first. Setting aside money that you put into your savings account from your paycheck right off the bat. Once you get accustomed to a budget, knowing what your monthly expenditures are, you'll be able to know that amount right away and kind of isolate that, move it over, don't touch it. Another thing you could do is actually set up with your employer a separate direct deposit, so you could have something going into your checking, but then also something specific going into your savings. If it's out of sight, it's out of mind, it goes directly into your savings account and you're not touching it. Another tip and trick could be just taking change. If you're using more cash basis by following a budget, you can just pick up your spare change and dump it in a jar. And that's something I think will be very helpful for most people, just as a little bit, just getting slowly to that cushion that Brenda was talking about.
But what do you do if you don't have extra money at the end of the month and say you're negative $55?
That's a great question, because it also comes back to what our original point was. You either have to increase your income or reduce your expenditures. In our example, if we were showing $55 negative, the first thing that we would be doing would suggest reaching out to one of our career consultants here at OhioMeansJobs Allen County and getting in and having an interview with them, having them assess where you are in life, and is there any other opportunities in our area that you would be able to find employment to increase your income as you're coming in. You can reach out to us directly via our phone, 419-999-0360. You could check out our website, which is OhioMeansJobs-Allen-County.com. Or you could come into our building here, come on site and look at our ever-changing jobs board. There are tons of local jobs right now, and it's constantly revolving, where we're taking some down that have been filled and adding new ones. So those are great resources for increasing that income.
Yeah, and I think there is no shame in asking for help. You know, everybody at some point is challenged, at some point financially. So I do recommend that people come in, stop in, talk with someone here at OhioMeansJobs Allen County. So any final tips for folks when they are making a budget?
I would say just tracking your expenditures in the beginning is going to be difficult, but sticking with it. Finding ways to follow through with what's going out of your account and reaching out to see if there's ways to reduce your expenditures. Contacting your car insurance to see about maybe there's a policy out there you can competitively quote to get it reduced. Doing that, cutting the cable, which was so popular here over the last couple years. So.
And those little things, Josh, add up. So when I was growing up, I vividly remember going to the grocery store with my mom. And, she had an allowance. So she would go into the grocery store with cash, and she had to make sure that she didn't go over that amount. And that was a great way to kind of keep your budget in check. So do you recommend that if someone is new to kind of budgeting and trying to get things in line, to maybe use cash?
Absolutely. So you could do an exercise where you just write up a list, and let's say that list comes out to about $60. Well, you take only $60 with you to the grocery store. If you only have $60, you can only spend $60. And this is a tough exercise, because there's going to come a point where you might have to pull things out of the checkout line and tell the cashier, I'm sorry, I'm unable to purchase that because I only have a set amount. But what this does is help make you disciplined in your purchasing. There's tons of noise out there. We're heavily marketed to. There's impulse items everywhere you turn. And walking through a store with a set amount of money will require you to only obtain that amount of goods. So I highly suggest trying that. And even if it's just a basic trip where there's not a lot that you're even purchasing, it just gets you used to having that feel of money and being structured. And I would highly suggest giving that a shot.
That's great, Josh. That's great information. And financial freedom is possible It's just going to take a little bit of work. It's going to entail making out a monthly budget and sticking to it, and making sure that what's going out every month does not exceed what's coming in.
Bingo.
Okay, thanks,
Great.
Josh.
Oh, thank you.
Great information.
Absolutely.
So before we go today, let's look at some Superior Credit Union spending tips. Avoid impulse spending. Go to the grocery store with the list and make sure you're sticking to it. Bring your lunch to work instead of buying fast food. Make that daily cup of coffee at home and bring it with you instead of stopping and buying that cup of coffee at work. Toss your spare change into a jar and deposit it into your account when the jar is full. Set up a direct deposit and put a portion of each paycheck right into your savings account. You won't hardly miss it. An important milestone is setting up a checking and a savings account. They are basic financial tools. A checking account is great for paying your bills. A savings account keeps your money safe, and it sets you up for financial success down the road. So before we start talking about how you set up an account, let's first talk about why having a savings and a checking account are very important tools in the budgeting process. Now, you might remember in our last segment, I talked with Josh, and Josh spoke about the importance of having a plan. It's really important because if you fail to plan, you plan to fail, and no one wants to fail. So how do we set ourselves up for success? Just like in making a budget, saving money requires SMART goals. So what are SMART goals? Let's go through them. They're specific, measurable, attainable, relevant, and time-sensitive goals. Let's take specific first. You should make sure your goals are clearly defined. Measurable, they should be goals you can actually measure so you can see the progress you're making. Attainable, goals should be realistic and achievable over time. Relevant, they should make sense and they should help you reach your ultimate goal. And time sensitive, you need to establish firm beginning and end dates. This helps you keep on track and helps you achieve success. So here's an idea. Who do you admire? Who do you consider successful? Study them. Study their habits, because I'm pretty sure they've practiced some sort of SMART goal process. So with me now is Adam Crow. Adam works here at Superior. And before we talk about opening a checking and savings account, Adam, does the SMART goal approach really work?
Yeah, SMART goal approach definitely does work. I think one of the issues that some people have is once they've achieved that goal, they don't set another goal to back that first SMART goal up. Just keep working on those goals as you achieve the first one.
Okay, so if I'm interested in setting up an account and I walk into Superior, what are the steps to do that?
So when you come into the credit union, most likely you'll receive a receptionist at the front of our buildings, and that individual will get you into an office with one of us. And what you would need is your driver's license or state identification card, valid of course, it cannot be expired. And we would also need a social security card to verify that you are who you're telling us that you are coming into the credit union today. And then also we need just $5 into the savings account to get that account open and ready for you.
Adam, in our last segment, we talked with Josh at OhioMeansJobs, and he stressed two things. That one, it's critical to have a budget. And two, that the money coming in is more than the money going out the door. Now, that can be hard for a lot of people, especially when we are in, stressful economic times. So for those folks that are living paycheck to paycheck, and as we talked about earlier, a lot of us are doing that. What are some tips on how we can save money going forward?
Sure. So One of the things that I stress a lot is, for myself, I'm a coffee drinker. So one of the easiest things is to leave the house and go purchase a coffee. I pass probably 5 to 6 coffee shops on my way to work, including gas stations, of course. And with that, if you're saving $2 per day, 5 days a week, that's already $10 a week that you've saved. And $10 for 52 weeks is $520 each year. Another thing, impulse spending. When you go to the grocery, take a list with you and stick to that list. That's a huge thing, especially for families. If you've got little children, you're walking in through the grocery, they're going to want that Lunchable, or they're going to want that pack of cookies that's not necessarily on the list for that week. And we got to try and cut down on those as much as possible. Another thing is toss that spare change that you acquire throughout the day, toss that into a jar at the end of the day, and then once that jar is filled up, take it into your local branch. We have free coin counters at a lot of our branches. Just take that in, give them your account card, and they will count that change and put it into your account for you. Put it right into the savings. That way it's not something that you were expecting, so put it away, and that way you'll have a nice little nest egg there in the future. Set up a direct deposit and put a portion of that directly into your savings account as well. This will be one of those things where you'll just forget that it's even there at one point, just because you're used to living on that specific amount out of that check each week. If you put it in that savings and you don't think about it, you won't even realize it's there until you need it. Another thing, review your bills and cancel services you don't use.
That's a big one, and there's a lot of areas here that you could address.
Yeah, absolutely. And guilty as charged. There's Spotify, Netflix, any of those type of services. If you're not using them, just get rid of them. Yeah, it's $5, $6, $10 a month, but that savings is going to add up, especially if it's something that's not being beneficial to you if you're not using it at all. So review that as well. And then finally, if you make your goal to save $500, when you can deposit that $500 into a savings account, you can apply for what's called our Share Secured Visa at Superior Credit Union. And what that $500 does is it is being held in your savings account. We use that as collateral against the card, and your spending activity reports to the credit bureau each month. This will help you build your credit or repair credit that possibly has been damaged from the past.
So I'm curious, what's the difference between a shared secure Visa versus just a regular Visa?
So a regular Visa, you're not using any collateral at all. You've shown to the creditor that you're able to make your payments and you're able to spend and not get way out of control. With a regular checking or with a regular Visa card, you're not going to have that. With the Share Secured Visa, you're using your own money as collateral, and then you're going to prove to the creditors that, yes, I can make these payments. Once you've used that for a little while, then you can look at getting into a regular Visa at that time.
Okay, so we've definitely established that having a savings account is important, very valuable. So now let's talk about establishing a checking account and how that can be useful and beneficial.
Sure. So a checking account is proof of payment or a paper trail. It allows withdrawals via check, debit card, ATMs, and then also you can stop into your financial institution and access your checking account as well. The benefits of having that checking account is safety. Safety is your checks or debit cards are missing or stolen. Your financial institution can help you get your funds back. If you lose all your cash, it's just gone. There's no replacing that. Proof of payment, if you lose a store receipt, your account will show the transaction. Easier budgeting, you can keep track of exactly where you're spending your money.
So Adam, when you open up a checking account, you're given a debit card. Let's talk about the differences between a debit card and a credit card.
Absolutely. So a debit card, even though it reads that it is a Visa, what that's telling you is that you are able to use that debit card wherever Visa is accepted, just like a credit card. With the debit card, though, you're using your money as opposed to a credit card where you're using the bank's money. So the difference is between buying now and paying now would be with a debit card, or buying now and paying later, which would be with your credit card.
So how do we keep our accounts safe?
So one of the biggest things I would say is make sure that you're not giving out your credit or debit card number. Don't give that out to any individuals, whether it's family members, friends. Do not give that out because it's exposed at that point. Also, your PIN number. You don't want to give out your PIN number to anyone as well, because then they have access to your ATM if they get a hold of your card as well. Immediately report lost or stolen cards to your financial institution. That's a big one. Unfortunately, there is a lot of fraud that goes on daily. It's probably one of the top 2 things that I deal with on a daily basis outside of opening new accounts and doing loans. Fraud is probably one of the top 2 things that we deal with, unfortunately.
Okay. So since your debit card is directly tied to your checking account, is it important to be regularly balancing your checking account?
Absolutely. And that's where you sometimes will find those issues of maybe you have been frauded and you didn't know until you go to balance your card or your checking account, then you will see that. Another tool that also helps with that is your online banking. You have access to your accounts at all times, so you would see those things early, and we could get your card shut down and work on getting that money back to you. You will receive a monthly statement, either online or in the mail, and you can use it to make sure that your records match what your financial institution shows for you. Here's how. Compare what you have with the statement to make sure every deposit and withdrawal shown on your statement matches your records. Check off all debit card receipts and ATM withdrawal receipts that show on the statement. Check off all deposits on the statement. Record earned interest and account fees from the statement on your check register or notebook. If you write checks, check off the check numbers that have cleared according to your check register. Next, note any checks, debit transactions, or ATM withdrawals that do not show on your statement. Note any deposits that you do not show on your statement. From your statement's ending balance, add the outstanding checks, debits, and deposits. Your record should match what the statement shows, or at least be somewhere close. If not, look for errors. It's easy to transpose numbers or write down an incorrect figure, something that I deal with almost probably a couple times a month especially. And financial institutions make mistakes too. For example, a check may have cleared for $35 instead of $350 or vice versa. Contact your financial institution right away if you find any discrepancies or if you're having trouble balancing. Keep in mind that statements show the previous month's activity, so you could have receipts left over. Just save those for your next month.
Okay, great. This has been great information. So just opening a checking and savings account is a great financial step in achieving financial freedom. So doing that in addition to spending the time and establishing a budget and sticking to it are all really important. Making sure that the money coming in is greater than the money going out is really important, and having these accounts helps you do that. Practicing SMART goals, really important. So review that and think about how that might apply in your own daily life and how those SMART goals will help you achieve, again, financial freedom. And study the habits of successful people. I promise you, if you kind of copy that, you too can be successful. In this segment, we explore what is credit. So, credit is borrowing money with the promise that you're going to repay it. And you're going to repay it with something called interest. Having good credit gives you better interest rates, for example, and lower insurance premiums. Having bad credit might keep you from being approved for a car loan, for instance, or renting an apartment, or down the line, buying a house. Credit scores are really designed to make the lending decision a little bit easier for banks and credit unions. So when you need to borrow money, they want to know how much of a risk you are and how likely you are to pay back the money that they lend you. So they take a look at your history, your borrowing history. So they want to know if you've borrowed money before. Did you pay back the loan? Or perhaps you stopped recently paying on a loan, and that can be a red flag. So back with me is Adam Crow from Superior Credit Union. Hi, Adam.
Hello.
Okay. Adam, can we think of a credit score much like a report card? So on a report card, you're given a grade, but a credit score is you're given a number. And if that's the case, what's a good credit score and what's a poor credit score?
Yeah, you could look at it as a report card with a number attached to it instead of your letter grade, of course. A credit score of 700 or above is generally considered good. A score of 800 or above is considered to be excellent. And most credit scores fall between 600, which is considered poor, and 750. Higher scores represent better credit decisions and can make creditors more confident that you will repay your future debts as agreed. So a breakdown of credit scores, if you're a 740 credit score or above, that's going to be our highest tier, and it's going to be your lowest interest rate.
And that's what we all really want to strive for.
Absolutely. Because you're going to pay less money in over the length of that loan
Yeah,
with the interest payments.
We're going to talk about that as we go forward here and give some examples.
And then, of course, you have your 700 to 739. You're still doing well. There's a little bit of room for improvement, but you're still going to pay less than, say, someone with a 500 or 600 credit score. And then once you're at a 650 to a 699, you're about right in the middle of where you're looking for an interest rate. You're not going to be the best, of course, but you're also not going to be the absolute worst. 620 credit score to 649. You're probably in the process of repairing, or you've had some missed payments or some collections there. There's some work to be done, but not to say that you can't still get a loan with us or with anyone else. And then a 619 and below, we've got some work to do. Come see one of us. We can help you through that and kind of push you in the right direction to show you what needs to be done to get that improved.
And that's okay. I would much rather someone seek help than not seek help and sink, more and more into debt and having problems. So, okay, let's talk about how a good credit score and how a bad credit score might impact how much we pay for a car, for instance.
Okay, so perfect example would be purchasing a car, say for $8,000. You're going to let's just look at a loan term of 4 years. If your credit score is a 740 or above, your interest rate's going to be at 3.89%, and your monthly payment is $180 and a penny per month, and your total interest on the loan is $650.82. So over the life of that entire loan, if you don't make any additional payments and you pay that out in the full 4 years, you're looking at a total cost of $8,650.82. And now once you take a look at the next example, which would be your middle of the road, maybe just a little bit below. If your credit score is a 640 to 699, your interest rate is 6.9%. At this point, your payment's $191.18 per month, and your total interest on the loan is $1,176.38. Already we can see a savings of $11.17 per month, and then the total, then that's looking at your 740 credit score to this one. You're already paying $11 less per month. Your total amount financed for a 640 to 699 credit score would be $9,176.38 over the life of that loan, so over the 4 years. And finally, if your credit score is at the 619 and below, your interest rate is going to be 14.9%. Your payment is $222.18 per month, and your total interest on the loan is $2,664.43. So that car that you thought only was going to cost you $8,000, now you're at $10,664.43. So you can really see the difference in having a good credit score and what that can do for you over the life of a loan.
Adam, that is significant. So that's a big difference in what someone's paying, obviously. So you're going to, again, strive for a high or strong credit score. So by having good credit, you can save yourself thousands of dollars in interest over the life of the loan. So that's for a car. So let's take a house, for example. Does the same philosophy apply?
Absolutely. When you're purchasing a house, the number one way to create net worth is to buy a home and pay it off. Buying is cheaper than renting. When you're renting, you're really not putting your money towards your net worth at all. It's going to the individual that owns the property that you're living in. So you're really not helping yourself out at all at that point. Good credit is essential for being able to buy a house, and you must have a credit score of at least 620 to be approved for a mortgage.
Okay, so let's flush that out a little bit.
Sure.
620. 620 is at the lower end of the credit spectrum, right? So what does that mean? That you can get a mortgage, much like a car, you might be paying a higher interest rate?
Absolutely. So just like in the example that we looked at with the vehicle, you're still going to pay a higher interest rate for being a lower credit score. It's going to be tiered just as your vehicle loan would be. So yes, you would pay more over the life of that loan for having a lower credit score. Like we said before, it's not to say that you wouldn't get approved at a 620 credit score, but you are going to pay more, that's for sure.
Okay. Well, I am no, financial wizard, and all the terminology can be overwhelming. It can be a little bit confusing. So I thought we could walk through some common terms so people have a clear understanding of what we're talking about, and that they're a little bit knowledgeable before they perhaps walk through your doors and try to set up an account. So let's first talk about principal. What is principal?
So principal is your borrowed amount. That's the amount, like in the vehicle that we looked at, the $8,000 vehicle. That principal amount is that borrowed amount, the $8,000.
Okay, then what does interest mean?
So interest is the amount that's tacked on. It's for the risk for the financial institution to take on you. That's why some of them are higher than others. That's what the interest is that additional fee that's charged.
So if we're applying it to the car loan, so the principal amount would be, say, $8,000.
Correct.
And then the interest would be that extra amount, which comes to $650. So you think you're getting that car for $8,000, but you're really buying that car for $8,650.
Correct.
Okay. Collateral.
So collateral, let's use the car loan as an example again. The collateral would be the security for the loan. So in that case, it would be the car title. The credit union or bank would hold on to that car title until that piece of collateral is paid off.
The term capacity, what does that mean?
So the capacity is your ability to make your monthly payment. So it's taken into consideration the amount of bills that you have coming out each month based upon your total income to see if you have the capacity to make the payments.
Okay. Character.
Character, that's your willingness as the borrower to repay the loan. And that's all going to be built into that credit score that we talk about so much.
Okay. And capital.
That would be your assets. So that would be your income. That would be, in some instances, it would be a home if you already own a home, or you have equity in the home. That would be an asset or capital as well.
Okay. And lastly, a charge off. What does that mean?
Charge offs, yes. So that's the unpaid account with the remaining owned balance. So say you have an old car loan that you had, you stopped making payments on it, and then you never made any further payments, but you still had a balance. That's still going to report on your credit report, and the creditors will see that. So that's what a charge off would be. It's something that you're no longer paying on. You may be paying on it, but most likely you're no longer paying on it. But it's been charged off of the books by that institution that held that loan for you.
Okay. So what are some key things we can all keep in mind when it comes to establishing good credit?
I'd say probably number one would be the better your credit score, the lower your interest rate. And we've talked about that over and over again. And it's really, we should be driving that home. A great credit score will help you get the things you want in life. One bad thing about a credit score is utility bills, medical bills, and cell phone accounts don't impact your credit unless your accounts go to collections. So you stop paying on those things, then those will negatively affect your credit. The second one I would say would be always pay your bills on time. Life's unpredictable and some hardships are unavoidable. If you have a problem making a payment, contact the creditor. It may be possible to make payment arrangements. And then finally...
So is it more important to at least make a payment than not make a payment at all? Like, does that help?
Yeah, absolutely. I would at least make a partial payment. They can see that you're attempting to make that payment, but then they can also see that there may be an instance there where something came up that
Now,
month.
that doesn't mean, though, that it won't go to collections.
Absolutely. It still could go to collections depending on how long you've made those partial payments. So yeah, that is one thing also.
And what are
But-
some things that negatively impact your credit score?
So late payments, which we've kind of touched on a little bit. Collections, that was the medical collections, the utility collections, phones possibly. Charge-offs, which we spoke about a bit, or not paying a bill at all. Foreclosures, repossessions, tax liens, and bankruptcies all affect your credit.
Okay. And try not to max out your credit cards. That's probably a really important rule of thumb. Spend moderately and wisely. So growing up, I remember my father would say, don't charge something unless you can pay it off by the end of the month. So kind of a good tip to keep in mind. So, all right, we know how credit scores then are established and how lending institutions use credit scores to decide if they are or are not going to lend you money. So how do you repair credit?
Okay. So one thing to kind of you got to figure out where you are to start with, where your credit report or where your credit score is. You'll need to see that first. So you're going to want to order a copy of your credit report, which can be done online at www.annualcreditreport.com. Once you've received that credit report, you want to look for any errors that may be on there. You can always dispute those with the credit bureaus. And there's phone numbers directly online that you can access as well for each one of those credit bureaus. Tackle accounts with delinquent payments first. These are accounts that are less than 180 days or about 6 months past due. Contact the creditors to see about setting up a payment arrangement. And this goes back to us speaking about making that partial payment each month. You want to address any charge-offs that you may have. Charge-offs are reported for 7 years from the date of the charge-off. And charge-offs, like we said, those are when you have something that you no longer pay on, but it's still showing a balance on your credit report. This can occur when someone is just 3 or 4 months past due paying a bill. This is serious, and it can dramatically affect your credit score and your ability to take out a loan in the future. In most instances, these charge-offs will then go to a collection agency. So just because a company writes you off doesn't mean you're off the hook. Another one is pay down your balances, beginning with credit lines that have the highest interest rates. And that's one I can't stress enough. A lot of people think that they need to pay off their car before they pay off a huge balance that they may have on a credit card. I always try and stress to them that they're not paying as much in interest for that vehicle that they would be on that credit card. So try and pay down that credit card as much as possible. Open a savings account. And when you have a balance of $500, open a share secured credit card and begin to build good credit. It's similar to a regular credit card, but requires you to put down a deposit or collateral.
So those are all really useful, helpful tips if you're wanting to repair your credit. But how do we rebuild it? And what's the difference between repairing it and rebuilding it?
So repairing would be working on the things possibly that haven't already been sent to collections, or those instances where you are 30, 60, 90, even 180 days late in some instances. By repairing it, that would be getting those payments caught back up. We want to get that back in good standing. We want to make sure that we're not late on those anymore. Work on those first. So that would be working on repairing it. Rebuilding, I'd say one of the bigger things would be to work on paying back those collections that have accumulated. Medical collections is probably the most frequent collection that we see on credit reports. And sometimes those will even show up. Once you've paid those, they're even going to report on there. But after a while, those will fall off and you will see an increase in your credit score. So I would say working on repairing that or rebuilding at that point would be working on getting those collections and getting your lines of credit back up to on time every month.
Okay, and we can't stress enough how important that is. So, Adam, lots of reasons to start on the path to credit repair. So the biggest reason is that credit affects you every single day. It affects the interest rates you're going to pay on credit cards and loans, including mortgages. It can result in higher security deposits when you're going to rent an apartment, for instance. It can also affect what you pay for insurance rates and what credit limits you qualify for. Good credit can mean financial freedom, and that's what we're all striving for, and it is possible. That way you don't have to depend on somebody to, say, co-sign for you. You can do that all on your own. So if you need to fix your credit or you want to maintain your existing credit, try to use the steps we've outlined for you over these various segments. Put them into practice. Practice them every day. Make the time. Carve out that time. Make a budget. Again, have a plan. Stick to it. And it's okay to ask for help. People like Adam at Superior and people like Josh at OhioMeansJobs. They're great resources or tools as you go through this whole path to financial freedom. So thank you for taking the time and for watching our videos, and happy banking.
Hopefully you found the information in the videos interesting and informative. At OhioMeansJobs, if you're looking for a job, stop one out and we can help you with that. If you're already in a career, we can help you advance your career and move on to something better for yourself.
Remember, you work hard for your money, and we want to help you make good financial decisions. With the tools you've learned here, we hope you can successfully manage your finances just a little bit better and save just a little bit more. At Superior, we're here to help you do just that.
Thanks again for watching.